Hi guys, welcome back. Was just cut off there by my recording service at a max of 10 minutes here. So I was describing this kind of off-mark trade at 96 spot 7710. Looks like they got a little better of a discount. I was just telling you guys about how this may be a friend and family trade of the underwriter. So and they are allowed to do that. So that's really no big deal. What we want to look at is just so that we understand what's going on here. We've got the initial discount, the underwriter's discount. We've got the initial offering price. And we see continuity of pricing while the underwriter stays in syndicate. So if there were other dealers in here, they would coordinate their efforts to maintain the continuity of pricing while they were technically quote-unquote in syndicate. If we go another page forward, okay, so here we see the price holding, and we see another couple of discounts here. Here is where things change. So all of these you're going to see customer bots. Here we see the interdealer trade. So these are other dealers that are accessing the underwriter. They're trading from dealer to dealer. A million bonds moved from one dealer to the next, and they purchased it at a discount there. So this issue would be said to have broken syndicate at this point. These extra couple of prints at 98 spot 854, we're probably not likely to see that exact pricing again right away. So now we're going to see the spread start to move and some disparity there that we can talk about. So here is a bond trade for 45 bonds or 45,000 par. Customer bought at 99 spot 17. Now mind you, this is on the 10th at 242, and just an hour earlier someone else bought. It was a retail customer, bought the bond for a little cheaper. So, and the difference there is that these investors purchased in the new issue order period, and these guys purchased technically on the secondary. We see another interdealer trade for 45 bonds, and we see a customer buy at 45 bonds. Okay, let's look at this. This is interesting because this looks like, and I'm pretty sure it is, a riskless principal transaction. So this dealer reaches out to either this dealer that bought here or the initial underwriting dealer, okay, and they buy 45 bonds at 98. They do that, that's a settled date, they do that on the 10th at 3:05 p.m. Okay. When this dealer went to the market to pick up these bonds, they already had an order in hand to sell these bonds to a customer at 100. So this customer bought 45 bonds at par. This dealer bought 45 bonds at 98. That's $20 per bond at 45 bonds. That's $900. And this dealer never had to inventory the bonds. They simply called up their buddy at either this dealer, or the initial underwriter and said, hey, give me 45 bonds at 98. So they sell them 45 bonds at 98. A broker calls his client on the phone, says, hey, I think you should buy these bonds, and he sells them to him at par. Says, they're a new issue, I can sell them to you at par. And the customer obliges. They buy the bonds at par, and 900 bucks is made, and the customer gets bonds. Well, that's fine. That's fine if you're okay with paying 20 bucks for your bonds, when you know that someone else is buying odd lots of the exact same bond at about the exact same time, 3 minutes apart, but they're paying $8 less. So if $8 times 45 or if $8 times 10 makes a difference to your wallet in your retirement picture, then you should care, and you should definitely at least understand and know this so that you can identify how you're being treated by your broker or advisor, or discount brokerage firm. It's important to know, and a lot of folks don't. So let's keep looking at this. I'll see if we can find anything else. We won't spend too much time on this. Okay, now we're on to the 12th, and these reports come in reverse chronological order, or most recent data first, which is why we had to go all the way back to the beginning. There's some more 10th trades. We're seeing more interdealer trades at 98. So somebody is holding, one of the dealers is holding these out to other dealers at a price of 98. And it looks like customers are marking up, or dealers are marking back up to around par. It actually looks like this guy marked up $19.60. And he probably did that just to stay under this mark. So if his client was savvy enough to use this website, he could say, I kept you under par. You're not the high water mark. Because no matter how many times they say it, a retail investor does not want to be this guy if he's the only one. There are a bunch of them, then that's okay, but you don't want to find out you're the only guy that's paying the highest price for a security. And when you find that out, you get pretty upset. So here at 3:30 on the 10th, we see an interdealer, looks like riskless, with a customer buy at the exact same time. That's $2,000 that somebody made for a phone call or by clicking a button. This is a secondary trade. This wasn't a new issue order. So we can see that $2,000 was made right here. It's 20 bucks a bond. Customer bought 100 bonds, and they paid par. The dealer bought at 98. So there you have it. Again, this is EMMA or MSRB, and these are post-trade prices. So it still leaves you in the dark, but if you can look at yesterday and you can see a 2-point spread and interdealers at 98, then you know that at least as late as yesterday that the broker or advisor that you may be talking to could have probably accessed that market at 98, and it may give you some leverage to say, hey, I don't want to be the guy that's paying 2 points or paying par. Why don't you ease that back a couple bucks, So if you know, you can point it out, and if you can point it out, then you've got a better chance of improving the price that you receive. So I'll go ahead and wrap this up here. This was understanding bond trades and looking at MSRB and EMMA, and hopefully it helps you guys out. Thanks a lot. Bye-bye.